We can talk about the possible recovery in Europe through the prism of euro-dollar. The chart showing the pair trading at the tightest quarterly range since the euro's 1999 inception. So euro-dollar really not going anywhere this quarter. Is that because the US and Europe economy actually have more similarities than differences at the moment?
Yeah, I mean, they've both been somewhat disappointing into the end of the fourth quarter and the beginning of the first quarter. Therefore, the question, certainly with regards to the currency pair, is how do those relative economic performances develop from here? In our opinion, again, to reiterate, we think the US is well priced. We think the US is going to continue performing OK, reasonably stably with a fairly benign Fed. We hope and think that the Eurozone is going to re-accelerate, so that should mean that the euro does better against the dollar in due course. The fact it hasn't been doing so recently is because the data in Europe has not been very clever.
What convinces you that the data in Europe is going to pick up from here?
Well, we're not convinced. I mean, you have to look at the first quarter and see how much disappointed to the downside, how expectations are in terms of growth. I mean, the ECB is still forecasting, or was, growth of 0.5 in each of the first three quarters of this year. And I think when they come back next week, they're certain to downgrade, obviously, the first quarter, but potentially the rest of the year as well. So, we do need to see evidence of a re-acceleration. And at the moment, it is scant.
So what are you doing about European bonds then? I mean, more and more people say, rightly, I guess, that bonds are very expensive from here. But the question is, do you actually want to short them without any real conviction that you're going to get a pickup in growth?
You need to be careful. I mean, yes, yields are very low, but they're low for a reason, which is downgraded growth and inflation expectations on a fundamental basis, and also the sort of safe haven demand that always feeds through into bonds when there's worries about the Eurozone and the prospects for economic recovery, and the worries about what it would mean if the economy doesn't re-accelerate, when both the ECB and a lot of national governments have no room for manoeuvre if the economy does need more assistance. So bond yields are here for a reason. Again, with a reasonably optimistic outlook for growth, we do think those yields rise, but we wouldn't be rushing in to short them aggressively, because clearly at this point the jury's still out. Is
there anything you're rushing to do in terms of positioning in Europe?
Not really, no. I mean, I think we have, let's say, we have a bias that the euro goes higher, that bond yields rise, and as a result of that some of these peripheral spreads continue to just moderate a little bit. But we think it's a slow process, and it will need to see some evidence that what's been going on over the past few months is an anomaly rather than a new reality. Because if it's a new reality, that's far more worrying for all of these assets.